Welcome to the Deep Dive. Today, we are taking a closer look at the recent earnings call for MercadoLibre, that's M-E-L-I, covering the quarter that ended, September 30th, 2025.
Yeah. And, if you just glanced at the headlines, you might think it was, maybe a bit shaky.
Right. Shares dipped a bit. But the numbers, they really tell a story of strategic investment, almost like warfare, strategically speaking.
They absolutely do.
Yeah.
I mean, this was a classic growth over margins quarter, would you say?
Totally. That's the tension right there. Management seems perfectly fine with taking some short-term heat.
And market disappointment, yeah.
In exchange for accelerating what they see as their long-term dominance in LATAM, both commerce and fintech.
Exactly. So that tension, that's why we saw shares down maybe 1.6%, 2% after the numbers came out. You had these two, conflicting narratives playing out.
Okay, so let's break that down. Start with the good news. The revenue side.
Yeah, the top line was definitely a success story. Revenue landed at $7.41 billion. That beat the street, which was looking for something around $7.2 billion.
So a solid beat.
A solid beat, yeah. And that's 39% growth year over year. Even better if you look at FX neutral, adjusting for currencies.
Which you kind of have to in LATAM.
You really do. On that basis, it was 49% growth. Quite robust.
And the consistency here is it's remarkable.
It really is. This marks the 27th consecutive quarter. They've posted revenue growth above 30%.
27 quarters. Just think about that scale.
It's almost unheard of, right, for a player this big in these markets.
But, okay, there's the other side of the coin. The price they paid for that growth, they missed on profit.
Correct. That's the other headline. GAAP EPS. So, generally accepted accounting principles, earnings per share, that came in at $8.32.
And the street was expecting?
Closer to $9.30, maybe $9.50. So yeah, a miss of about 8 to 12%, depending on whose estimate you look at.
And the main culprit was?
The EBIT margin, it came in at 9.8%. Now that's flat compared to last year, but it's a multi-quarter low.
Ouch. 9.8%.
Yeah. And that's what the market really focused on, asking why invest so heavily right now if it hits margins like this?
Okay, so let's challenge that market reaction. Management basically said this margin hit was planned, right? A necessary cost.
Exactly. They framed it as intentional investment to, spin that ecosystem flywheel faster.
So where did the money go? What were the big investments?
Primarily Brazil. Specifically, the marketplace in Brazil, leveraging their logistics network through pretty aggressive shipping subsidies.
The free shipping threshold reduction.
That's the one. They lowered it significantly. And honestly, the results came through almost immediately. GMV, gross merchandise volume, grew 34% FX neutral.
Okay, 34% is strong.
It is, but the volume acceleration was the really eye-popping part. Items sold jumped from 26% growth last quarter,
which is already good,
to 42% growth this quarter.
Wow, okay, that's a huge jump. 16 points of acceleration just from cheaper shipping.
It's massive. And it brought in the biggest wave of new, unique buyers they've seen since early 2021.
So the demand elasticity was there.
Clearly. And it wasn't just buyers. More sellers came onto the platform, too, especially listing items in that sort of 19 to 79 real price range. Management bet on volume. And, this quarter, they definitely won that bet.
Now, this is where it gets tricky or interesting, depending on how you look at it. They're pouring cash into shipping subsidies.
Right.
How did they manage costs on the logistics side? Did they offset any of that spend?
They did, somewhat. Through scale. It's fascinating, actually. Because transaction volumes went up so much, they achieved greater operational density. And get this, unit shipping costs in Brazil actually decreased 8%.
Decreased sequentially?
Sequentially, yeah, quarter over quarter. Even with the subsidies flowing out.
How?
Mostly by leveraging unused capacity, filling up trucks, using slower, cheaper delivery methods where possible, and just overall scale efficiencies kicking in. Plus, they mentioned continued improvements in fulfillment out of Mexico, too.
Okay, hold on. If they got an 8% sequential cost decrease on shipping units, why wasn't that enough to offset the subsidy cost and prevent the margin miss? Does that mean the subsidy was even more aggressive than maybe even they expected, or at least more than the market modeled?
That's the million-dollar question, isn't it? Or maybe $1 billion, given their scale. It does suggest the subsidy push was very, very aggressive.
More than the cost savings could cover.
Exactly. It confirms management's priority right now is grabbing market share, maybe even at the expense of near-term profits, or, keeping shareholders perfectly happy quarter to quarter.
They're buying customers, viewing that subsidy as customer acquisition cost, or CAC.
Precisely. Not a permanent cost structure change, but a strategic investment. And speaking of strategy, they also mentioned an internal push on seller pricing competitiveness.
Making sure listings are sharp.
Yeah, basically ensuring items that offer the best overall value, speed, price, payment options get prioritized in search. They called it a short-term test, happening while competitors are also running initiatives. It's about the best customer experience.
Okay, that operational push makes sense. Let's pivot to the other engine. Mercado Pago, the fintech arm, this is really the long-term profit story, isn't it?
Absolutely. It's becoming a fully integrated digital bank, essentially. The scale now is just huge.
Give us the numbers.
Okay, the loan book hit $11 billion. That's up 83% year over year.
83% growth on an $11 billion base. Wow.
Yeah. And acquiring TPV, so the total payment volume running through their system hit $47.7 billion. That's up 32%. Just massive flows of money.
Okay, $11 billion loan book, growing fast. But what about risk? They mentioned the 90-day plus delinquency rate was 6.8%. That's not insignificant.
It's not insignificant, no. But management was very clear on this point during the call. They stressed they're growing this portfolio without compromising on credit quality.
How can they be so sure?
They pointed to all-time low first payment defaults.
Yeah.
That's a key early indicator. And if you connect that to the bigger picture, their credit card cohorts are maturing nicely.
Meaning the older loans are performing well.
Exactly. Cohorts older than 2 years are consistently profitable. And in Brazil, they said nearly half of the credit card volume they're issuing now is already profitable.
Okay, so that suggests a future tailwind for margins as these newer, larger cohorts mature.
A huge potential tailwind, yeah. It should really start hitting the P&L more visibly in, say, 2026, as those loans season.
And to keep those profitable customers sticky, they talked about principality. Remind us what that is.
Right, principality. They define it as when a customer has 50% or more of their income flowing through Mercado Pago. It's like the ultimate measure of financial integration, right? Becoming the primary financial relationship.
And how's that trending?
Trending well. They reported an 11 percentage point increase in Brazil and a 2-point increase in Mexico for that metric.
And how do they plan to drive that even higher?
Two main things they called out for the future. First, getting that banking license in Mexico, which they're working on. That's a potential game changer there. And second, improving salary portability in Brazil, making it easier for people to have their paychecks deposited directly into Pago. Still lots of room to grow there.
Okay, let's talk geography a bit. We have to touch on Argentina. Memeli's home turf, but always volatile. How did the macro situation impact things this quarter?
Yeah, Argentina was definitely a bit of a drag on the overall growth rate. You had the political uncertainty around the midterm election.
Wait, always noisy.
And high interest rates.
Yeah.
Those high rates directly increased MEI's funding costs for their credit products there and just generally dampened consumer spending. So, yeah, GMV and TPV growth slowed down through the quarter in Argentina.
How worried is management about that?
They portrayed it as manageable volatility.
Yeah.
No part of doing business there. Despite the headwinds, revenue still grew 39% year over year in US dollars.
Which is still strong.
And it was 97% in local currency. So they're still growing rapidly underneath the noise. And they emphasize they're optimistic long term. They're actually investing through the cycle there, opened a second fulfillment center, launched the credit card. They're not pulling back.
Okay, so Argentina's a bit bumpy, but they're powering through. What about other key markets? Any bright spots?
Yeah, Chile and Colombia looks strong. Chile accelerated GMV growth for the third quarter in a row. And Colombia's growth picked up by over 10 percentage points just from Q2 to Q3.
And what's driving that strength?
Pretty much the core playbook. Leveraging logistics, improving the product selection available, and effective demand generation marketing campaigns. Just executing well.
All right, let's bring it back to the overall outlook. Given all the spending, this margin pressure, what's the message on guidance? What should we expect going forward?
The message was crystal clear. Long-term value creation and market share capture are the priorities. They are willing, even planning, to accept this kind of margin pressure in the short term to achieve those goals.
So don't expect margins to snap back immediately.
Probably not dramatically. The street seems to be tracking revenue growth for the next 12 months, somewhere around 28%.
Which is a slowdown from the 39% headline this quarter.
It is deceleration, yes, but look at the scale they're operating at. Growing nearly 30% on top of this huge base is still exceptionally strong.
And where will future investments be focused?
They mentioned continuing to scale the 1P business, that's their first-party retail, where MELI sells directly. That actually grew 71% FX neutral this quarter, so it's working, and also accelerating the rollout of the credit card in newer markets like Mexico and Argentina.
Got it. And, of course, the buzzword, AI. Any color on how MELI is using it?
Yeah, they touched on it. They definitely view agentic AI as the tool they can use now for productivity and helping users discover things.
Any specific examples?
They launched a new conversational tool for sellers, basically an AI assistant to give them advice. And they also launched their first AI assistant within Mercado Pago itself, helping users with tasks like scheduling payments through just, talking to it early days, but they're integrating it.
Okay, time for our favorite segment, the one that makes the compliance department nervous. Quick disclaimer. This is absolutely not financial advice. We're just tossing around some, let's call them outrageous but plausible ideas based on the call.
Kevin, do your own research. But yeah, looking at the themes this quarter, an idea does kind of jump out.
All right, lay it on us. What's the outrageous but plausible trade inspired by MercadoLibre's Q3?
Okay, so the thesis is this. The market is myopically focused on that 9.8% EBIT margin number. It's treating the shipping subsidy splurge as if it's a permanent new cost level.
Instead of a temporary customer acquisition tool.
Exactly. But look at the results of that spend. Buyer growth accelerated massively. The credit book hit $11 billion and is scaling profitably underneath. The flywheel is spinning faster, not slower. Management is using the P&L as a weapon to widen their moat right now.
So the market is missing the forest for the trees. Focused on the immediate cost, not the long-term gain. It's impatient.
Suffering from delayed gratification, you could say. So the trade is to bet on that gratification eventually arriving. Bet on margin recovery.
How would you structure that?
You'd want a long position, betting specifically on margin normalization kicking in during 2026. Given the stock's around, $2,128 now, an aggressive way to play it could be a long-dated call spread.
Targeting what kind of price?
Aiming for a price well above $2,500, maybe expiring towards the end of 2026. You're essentially buying the story that this margin dip is temporary and strategic.
And the catalyst would be?
Future guidance, specifically the 2026 margin outlook. That should show the impact of easing off the most aggressive subsidies once share goals are met, plus the growing contribution from those maturing, profitable credit card cohorts we talked about.
Interesting. Okay, so wrapping this up, a core takeaway seems to be this is just MELI doing what MELI does.
Pretty much. It reinforces their classic playbook. They will sacrifice short-term metrics when they see a chance to solidify future market dominance.
And the track record speaks for itself, right? Those 27 quarters of 30% plus growth show the strategy has worked for them before, repeatedly.
Absolutely. So this current margin pressure, it's arguably the calculated price they're paying for future leadership across LATAM commerce and fintech. It's an investment.
Which leaves us with a final thought for you, the listener. Given that MELI managed to accelerate its core commerce growth and grow its huge credit book by 83% year over year, while apparently keeping credit quality in check.
With things like all-time low first pay defaults.
Right. How long can the market rationally keep punishing the stock for investing heavily in what seems to be a successfully expanding high-margin profit center within the business? That's the real tension to watch.
That's the key question. How that resolves will likely shape the story over the next year or two.